Every time the Fed raises interest rates, the stock markets react. Stocks go up, stocks go down. But why? What's the correlation between the stock markets and interest rates? Welcome to Toyosi's Finance, where we break down money, business, and strategy in simple terms. In today's video, we'll answer the question, why does the stock market actually move with interest rates? At its core, a stock price is actually based on the value of future earnings. So when you buy a stock today, you're actually buying into the future earnings of that company. So think of it like this. Would you rather have $100 today or $100 in 5 years? Most people choose today because it's actually worth more today. And this is exactly how interest rates actually discount the future. So when rates goes up, the future earnings of a stock actually worth less today. So prices would fall. While on the contrary, when rates reduce, the future earnings of that stock is worth more today and the prices will also go up. And that's the concept of discount rates. But it actually affects different stocks differently. For example, with growth stocks such as tech companies, they actually make most of their money in the future and are valued based on expected growth. So when interest rates goes up, they're heavily discounted, so their prices will fall. While for value companies, they have more stable earnings and actually generate more cash today, so they are less sensitive to interest rate changes. So the further into the future that the profits of a company is, the more sensitive the stock price of that company is to interest rates. So let's make this more practical. High growth companies such as tech companies, when rates go up, the stock prices of these companies fall. While for value companies, when rates goes up, the stock prices are actually less sensitive to interest rates. But in the case of a bank, it's different. When the rates actually go up, the stock prices of banks also actually increase. Because for banks, higher interest rates actually equals higher earnings. For example, if a bank actually lends you money at 2% today and the interest rate increases to 5%, now the bank is actually making more profit. So when rates are up, the banks actually perform better. When interest rate changes, it actually affects how a company is valued, where investors put their money. In summary, for growth companies, when rates are up, the stock prices actually drop, while for value companies, when rates are up, they are less sensitive to it. And also for growth companies, when rates are down, the stock prices are actually up. And for banks, when rates are up, their stock prices also increase. In conclusion, interest rates actually changes how investors value the future, and the stock market is all about pricing the future. So next time when you hear that the Fed actually increased or kept the rates as it is, you understand how it also affects the stock market. Thank you for watching this video. If you found it useful, give it a thumbs up and also follow Toyosi's Finance. Goodbye.